Welcome back to Switzer on Australia's Business Channel. 2013 was a positive year for commercial property. For his views on 2014 and where he'll be investing, we're joined by Jason Huljich from Centuria. Mate, welcome to the program.
Thanks for having me, Marty.
Talk us through what Centuria does, Jace, first up.
Sure. So Centuria is a ASX-listed specialist fund manager. It's got two main divisions. We've got financial services, so that's friendly society investment bonds, insurance and mortgages, and they have an unlisted property fund division. So we buy commercial property, we put them into unlisted property funds, and then we have a large number of investors that invest with us. So we have a lot of self-managed super funds, and we also have some offshore institutions and wealthy family offices that invest into the funds.
In your unlisted funds, how many investors normally make up a fund, roughly?
Look, anywhere from 5 to 200.
Okay. So when we talk about commercial property as well, what are we actually referring to in terms of the assets that are in the fund?
Sure. So it's a little bit confusing. So commercial property doesn't just mean office assets. So commercial means pretty much non-residential. So you've got office, you've got retail, which is shopping centres, and you've got industrial, which is storage and logistics.
So commercial property, three sort of key
three main
areas:
sectors.
Office, retail, and industrial. So how did the market perform in 2013?
It was a pretty good performance. So if you look at the whole market, so all those sectors together, it returned about 9% in total. So that was made up of just over 7% in income return and just under 2% in capital growth. So a pretty good year. If you look at those three sectors individually, they were all around 9%. They range from high 8s to mid 9s. So they were all around that 9% total return. So it didn't blow the lights out, but it was a pretty good, stable year.
So when you look at it from the perspective of being a fund manager, where did you see the opportunities last year?
Look, we really like commercial property, and we like that price point of 50 to 100 million. When I say commercial, I mean actually commercial office.
Office, yeah.
Yeah, and the reason we like that price point is most private investors, the wealthy private investors, can buy up to, usually they buy 30, 40 million and taps a lot of them out. And most institutions like $100 million plus assets. They like the big, bulky assets. So in that $50 to $100 million, we see sort of decreased competition. There's still competition there, but less than some of the other price points. So we really concentrated on that last year, and we had a good year. We bought about $250 million worth of assets, so 3 large assets.
What are the examples of some of the businesses that you bought?
Yeah, so we bought, all 3 were in Sydney, so 2 were in the CBD, and we bought 1 just on the city fringe. They were all in that range. They were all very high quality modern office buildings.
Good quality long-term tenants.
Yeah, long-term tenants, good range of government and large private companies. That's right. And look, we've already seen some great results. One of the assets we bought in late April, so we owned about 8 months, and that showed 22% in those 8 months. So there are opportunities out there.
What was the breakup of that return?
Look, that was just over 9% in income, and the remainder in capital growth. So we saw some great capital growth.
And was that because you were able to exit that?
No, we still own it, but the latest valuations have just come in, and we saw quite a spike in that particular asset. We thought we bought it pretty well. But they're all travelling very well. So the opportunities.
So getting a valuation is how you actually determine the capital growth side of things.
That's right. So we're
selling it, obviously.
That's right. So we usually get a valuation every 12 months to keep investors up to date on where the value is going of their property. And then obviously when the property's sold after 4, 5, 6 years, that's when you can actually realise your capital growth.
Okay, so the year ahead, where do you see opportunities for investors in commercial property?
Look, we still like that same price point, and that's where we'll be focusing on. But I think we'll probably buy in some of the other sectors this year as well. So we'll buy office, but we'll also be looking at the retail and industrial sectors.
Is that a diversification to your sort of
it is, and we're seeing
model?
some value in some of those sectors as well, so we want to concentrate on them.
So retail would be like a shopping centre?
Yes, we like some of the neighbourhoods, those sort of $40 million, $50 million price points that are not discretionary spend, but you've got a good anchor, a Coles or a Woolies with some strong specialties.
And is the interest for you on the in terms of that as an investment which you take to your clients, the fact that you see an improving economy, you think that retail numbers will improve, and it's a good time to get an asset at a good price and ride that market up?
It is, but we'd be quite specific in what sort of, let's say, retail asset we bought. One with a lot of fashion and so forth, we'd probably stay away from.
Okay.
Ones that are non-discretionary is the ones that we really focus on.
So more of the staple type businesses.
Exactly.
Yeah. And what sort of returns can you expect, or should an investor expect, from commercial property in the year ahead?
Sure. Look, I think it will be a little bit better than last year.
Income, better than 9%?
Yeah, look, I think income returns will be similar. So, most of our funds return sort of 8 to 9% income. But I can see some yield compression because there's a lot of money chasing property at the moment, especially offshore money, and the institutions all looking mainly at the big shiny towers, the premium end of the market. Where we hunt is what we call the secondary market. So still very quality,
50 to 100 million?
High quality property, but it's the A grade and the high B grade, the next sort of level down. And historically, the yields you pick those up on are a lot lower than they are now. So I can see some yield compression, so you'll get some more capital growth, I think, this year.
Yeah.
And I think the leasing fundamentals will improve a bit. So I think we'll probably outperform last year. But look, we aim in that sort of 12%. If you look at all the funds we've wrapped up over the years, about 21 funds, which we've actually sold out of, given the money back to investors, we've shown just under 15% annual return.
Now, we're just about out of time, but one quick question. What cities do you like?
Sure. Probably Sydney and Melbourne, especially on the office side. The two largest office markets, even though leasing's been soft across the country, they're the two strongest markets and should hold up pretty well over the next 12 months.
Thanks for coming on the program.
Thank you very much.
After the break, we'll tell you how to get your SMSF into gear for 2014.